2022 is a year we want to be somewhat defensive and not be, say, leveraged long some of these, inflation commodity plays, and be open to the fact that I think 2022 could continue to be a rough and choppy year for a lot of different assets. We're potentially entering a disinflationary cycle in the US within the broader context of an inflationary decade. And so the supply side for commodities are still very inflationary. There's not much energy capex happening. And so I think those are structurally inflationary pressures. And given how high debt is, it's very hard for central banks to meaningfully raise rates, to normalize levels, to positive real rate levels. And so I think cash is in a structural devaluation period. And so I think holding hard assets in general is the way to go for this decade, with the caveat being that, having some cash for rebalancing optionality. And I do think that 2022 is a year we want to be somewhat defensive and not be, say, leveraged long some of these, inflation commodity plays, and be open to the fact that I think 2022 could continue to be a rough and choppy year for a lot of different assets. I've often joked that cash is actually the one speculative asset I own because it's the one thing that I know is going to lose value, but that I still hold some anyway, due to the possibility that other things I actually want to own could go down and have a
Right.
volatile period.
Right.
Especially also if you run a business, if you have a household, obviously you need working capital, and so I wouldn't overweight that too heavily. But in the context of entering potentially more volatile period, I think having a non-zero cash position and being able to rebalance into any stresses that happen can be useful. Basically, the Fed has kind of two competing forces right now. So on one hand, they're the furthest behind in inflation they've been since 1951. So CPI is 7%, rates are at zero, and so they're very far behind the curve as measured that way. The other side of it is that most measures of economic growth, like, so for example, purchasing managers indices, forward quarterly GDP growth rate estimates, those things are rolling over, they're softening, and so they're not necessarily pointing to recession, but they're pointing to a deceleration of growth. And historically, the Fed is most able to tighten policy into periods of economic acceleration. So PMIs going higher rather than lower. In fact, part of what caused so much market turbulence back in late 2018 was that they had been hiking the rates during that rising PMI environment, and then as PMI started to roll over, they kept pushing it, and eventually, the market gave them pushback. And so they're in this kind of tough position where inflation says to hike and the economic growth rate says soften. And they're already, near as dovish as they get. And then the kind of the macro backdrop for this whole thing is that with federal debt to GDP well over 100% and private debt to GDP even larger, basically that if they were to normalize to structurally positive real yields, so several percentage points of real yields, the interest burden would be very massive on that debt. I think my base case is that we're going to have negative real yields for most of this decade. Now, there can be brief periods where you have, say, a deflationary event. You can have these cycles, but I think that's the baseline going forward. And again, like you point out, that doesn't mean they can't hike. I think they certainly can taper the balance sheet. I think they can get some hikes in, but I think it's going to be relatively shallow compared to how much inflation's in the system. I think whether inflation is tamed is mostly outside of the Fed's hands. I think there's other variables. So a big drive of inflation was the fiscal stimulus. And so as that pulls back to some extent, right? So we're not getting more and more stimulus checks going out. We're getting kind of that fiscal pullback. That should contribute to some disinflationary pressures, maybe within this larger inflationary context. The other thing to watch is what happens with energy, fertilizer, these types of key commodity inputs. And so on that side, you have supply-driven inflation. There's not been a lot of investment in those areas, especially energy. CapEx has been very low. Oil discoveries have been very low. There's not a lot of resources going to even the energy infrastructure, so the pipelines and the transportation infrastructure. And so we have a lot of shortages in that area. And I think that's more structural throughout the decade. And so I think we're basically going to have these ebbs and flows. The Fed can reduce demand to some extent, right? So they can slow down economic growth, but then that has its other set of problems. And so I think their tools are somewhat limited, and it's more about watching the fiscal side and watching what happens with some of these supply issues and CapEx. Given that the the PMIs and other economic indicators are decelerating, that's not a very good environment for equities. And I avoid giving specific year-end price targets for, say, the S&P 500. If you look at, say, Wall Street, there's almost no correlation between price target estimates and the actual outcomes. Instead, I just give a general outlook of whether or not the conditions look very favorable or not. And so over the past 2 years, we've had very strong, almost straight up in terms of large cap equities. But my outlook since December recently has been that 2022 looks like a much choppier year. And that could be maybe it chops sideways, maybe it goes down, maybe it goes up at a slower pace. So I don't have a specific view other than that I think it's going to be a less attractive environment for equities than last year or the prior year were. So I rarely make, kind of sweeping portfolio decisions. There's all sorts of tax implications with that. But I overall view that this is an environment for defensiveness. And so that can include having hedges, that can include raising cash, and that can include being diversified into other assets. So, for example, I still think that there are reasonable choices within the value sector. I think precious metals are attractive. Bitcoin had a large sell-off, and I think that's also probably going to have a choppy year, but it's more in value territory now. I think some emerging markets are reasonably attractive. And so I think if someone is diversified and rather defensive, they can avoid some of the more severe scenarios while still participating in some of the markets that are actually pretty cheap and that have some growth. You can consider kind of emerging markets to be the more volatile, growth-oriented way to play it. So, for example, I've been bullish on Brazilian equities. I think if you look around broad emerging markets, especially emerging market value, they're reasonably attractive. But of course, there's a lot of risk. There's a lot of volatility. Gold is a somewhat less volatile choice, a more defensive choice. It generally does well in economic decelerating environments, especially if the Fed is forced to be less hawkish, even if they're still being hawkish. They're still tightening, but maybe less aggressively than the market priced in. Gold tends to move on these crisis events. Over the longer run, it's really about what happens with the currency. But if you have, if this disrupts energy, it seems like it's going to disrupt fertilizer to some extent, to the extent that it causes inflationary pressures, especially stagflationary pressures, rather than that kind of, pro-inflationary kind of, bounce back type of scenario. If it's actually more of a stagflationary supply side issue, that can be quite good for gold. And so it's one of those kind of tail risk diversifiers in a portfolio. A lot of people focus on rate differentials, but it's also about how attractive U.S. growth equities are for the rest of the world. So if the rest of the world decides to pull out of some of those large cap equities, that would be dollar negative. And a similar thing would happen in the early 2000s when a lot of capital pulled out of the NASDAQ bubble. That was dollar negative for the next few years. So I think that's my base case. But it is, you're comparing it to the euro, you're comparing it to a bunch of other weak currencies as well. So my broader view is that fiat currencies in general are going to devalue with negative real yields. But if you start to get that capital rotation, the dollar could have a pretty significant weak period. What I'm talking about here is mostly about capital flows. So right now, there's a lot of capital stuffed into U.S. markets. So Americans are historically underweight foreign markets compared to their average. They have more capital in U.S. equities than normal. Their highest household allocations ever to equities as a percentage of their assets. And then the foreign sector, like foreign pensions, foreign sovereign wealth funds, are also heavily allocated to American equities.